IRAs are a great way to save money for retirement, but in order to use them right, you need to understand them, and they can be pretty confusing. Aside from all the rules, there are actually several different types. If you're wondering what kind you should get, or how you should use the one you already have, you've come to the right place. The reason why investment is so powerful is because of something called compound interest. By reinvesting money that you make in one year, you make even more money the following years. In that sense, any investment income that is taxed in the short term deprives you of a lot more money in the long run. On the other hand, taxes are applied only upon sale for capital gain, which is the difference between what you bought an asset for and what you sold it for. This might not seem like a problem, but because of inflation, the value that you're taxed on is going to be much bigger than what you actually made. In fact, if your investment gave returns lower than inflation, you could even owe tax despite having lost value. Thankfully, there are ways to deal with these problems. One approach is through tax-advantaged arrangements. Generally speaking, these are special programs that the government allows people to use to avoid having to pay tax in some form. These programs often have a limit on the amount that you can put in. That way, everyone has the opportunity to save effectively, but those who have more still pay tax. The United States has many kinds of tax-advantaged arrangements. Some are designed for healthcare savings, and others are intended for college expenses. That being said, those for retirement are probably the most well-known. IRAs are one kind, but there are many others. For example, you've probably heard of, or even have, a 401k. These, like 403bs and others, are a kind of qualified retirement plan, which are tax-advantaged arrangements that you specifically get through your employer. Qualified plans are worth learning about, but they might be even more complicated than IRAs, so we won't be talking about them in this video, with one exception later on. Unlike qualified plans, IRAs can, for the most part, be opened by anyone. They're usually managed by brokerage firms or banks, and can be pretty normal investment arrangements aside from the special tax rules that they have to follow. For most people, IRAs look just like brokerage accounts. Now, there are a few different kinds of IRAs, but there are still certain rules that apply to all of them. First, you're limited in the amount you can put in, or contribute, for every year. In 2021, that limit is $6,000, or $7,000 if you're 50 or older. Contributions can be made up to this amount for a given year, starting on January 1st of that year, and going until the standard tax filing deadline of the following year, which is usually April 15th. However, even if you contribute a total that is under this limit, you can't put in more for a given year than your taxable compensation for that year. This is a very specifically defined term, but for most people, it includes any money made while working, either as an employee or for yourself, that isn't explicitly excluded from your income on your tax return. The only exception to this is through something called a spousal IRA, which isn't an actual type of IRA, but rather a term for when someone can contribute more than their taxable compensation by counting the taxable compensation of their spouse toward their limit. Another important rule with IRAs is that you're restricted in what you can invest in. One such prohibited activity is using IRA funds for loans or loan securities. You also can't make investments or purchases that involve a disqualified person, which is anyone in your family or in the organization that manages your account. Finally, you also can't purchase life insurance or collectibles, or buy things, like a house, for personal use. Other than these restrictions, you legally have a lot of freedom in terms of what you can invest in. You really can hold an entire house in an IRA. However, there are practical restrictions in terms of what the manager of your account can accommodate. For maximum flexibility, there's something called a self-directed IRA. As with a spousal IRA, this isn't an entirely separate kind of account. It's just a way to refer to flexible IRAs in general. These kinds of IRAs require a lot more work to manage, and so have much higher fees. This means they aren't usually worth it for your average investor. Thankfully, the advantages of IRAs are even greater than their limitations. For one thing, any gains that you make within the account are not taxed, which, as we mentioned earlier, can be huge in the long run. On top of this, you don't even have to report them to the IRS. For lower and middle income investors who put all of their investments in their IRA, this makes tax filing much easier. In this sense, IRAs can be a tool that could allow you to file your taxes yourself, saving money on accounting fees. However, in addition to benefits for gains, IRAs offer additional tax benefits, either when the money is put in or when the money comes out. This difference is why there are two main kinds of accounts, traditional IRAs and Roth IRAs. Traditional IRAs are tax deferred. This means that you get a tax deduction on the money that you put into the account in any given year. For example, If you make all of your money from a salaried position and have a taxable income of $40,000, your tax burden would normally be about $4,600. However, if you contribute $6,000 that year to a traditional IRA, you'd only owe about $3,890 in federal income tax. But remember, this account is tax deferred, not tax-free. Any amount of money withdrawn from the account will count toward your total taxable income for the year in which you take it out. Speaking of withdrawing, there are some age restrictions to keep in mind. After all, it is a retirement account. While you can legally withdraw the money at any time, if you take the money out before you're 59 and a half, an additional 10% penalty is incurred in addition to the tax that you would owe. However, there are several exceptions to this age restriction. First, if you die or suffer a total permanent disability, the money in the account can be withdrawn penalty-free. In addition, you're allowed to take out up to $10,000 over the course of your life to cover costs if you're a first-time homebuyer, which is a very technical and precise term that refers to a person who is buying a home and who hasn't owned one in 2 years. Finally, you can withdraw money to cover higher education expenses for yourself, your children, or your grandchildren, and you can take out up to $5,000 after the birth or adoption of a child. For all these exemptions, except for the last one, you're not allowed to put the money back afterward, so taking advantage of these situations decreases your potential tax savings in the long run. Aside from the rules for when you're allowed to take your money out of a traditional IRA, there are some rules for when you are required to. The IRS mandates that anyone who reaches the age of 72 must begin to remove funds from their IRA by April of the following year. As if things weren't complicated enough, there are a few other rules that apply to traditional IRAs. First, if you or your spouse are covered by a retirement plan at work, even if you don't use it, you may be limited in the amount of deductible contributions that you can make. This creates a very confusing subcategory of IRA contributions called non-deductible contributions, for those between this limitation and the maximum yearly contribution. In this situation, money will be taxed going in and coming out. However, it's still frequently preferable to do this instead of not making contributions, since you don't pay investment income taxes when the money is in the account. Accounting for non-deductible contributions can be very confusing, since you'd have to keep track of what portion of money in your IRA can be attributed to non-deductible contributions versus the deductible ones. To simplify things, people in this position might open an IRA account specifically for non-deductible contributions. You might hear people refer to this as a non-deductible IRA. In addition to traditional IRAs, the IRS also allows people to open up tax-exempt Roth IRAs. Tax-exempt doesn't mean tax-free either. Unlike traditional IRAs, contributions can't be deducted from your tax return, meaning that you've already paid tax on any money that you've put in. However, no tax is due on any withdrawals from a Roth IRA account. This fundamental difference in how you contribute has big effects on many of the other rules relating to this type of account. For example, contributions to a Roth IRA can be withdrawn at any time, since you've already paid taxes on them. The rules about withdrawing past what you contributed, meaning what your investments made, are complicated. For those under 59 and a half, withdrawing investment earnings would trigger both penalties and taxes. However, you can use the same exceptions that we talked about with the traditional IRA for the Roth IRA. In that case, if your first contribution to any Roth IRA account was less than 5 years before, you'd owe taxes, but no penalties. If that contribution was more than 5 years before, you don't have to pay a thing. Meanwhile, if you're over 59 and a half, you can withdraw investment earnings at no charge if your first contribution was more than 5 years before. If it wasn't, you'd still owe taxes. Unlike the traditional IRA, the Roth IRA also comes with built-in contribution limits. If you make more than $124,000 and less than $140,000, you can only contribute a fraction of the $6,000 you're normally entitled to, whereas income over $140,000 disqualifies you entirely. On the other hand, Roth IRAs do not come with minimum distribution rules. The money can stay there until you die. Generally speaking, your tax savings with IRAs are a function of comparing your highest tax bracket when you're retired with your highest tax bracket when you're working in any given year. So for example, let's say you hope to retire with an income of $60,000 a year. If that money comes from a traditional IRA, you'll be paying 22% on a portion of that income. However, if you contributed to that traditional IRA in a year when your income was $40,000, the tax rate you avoided with that contribution was 12%. In that case, it generally would have been better to use a Roth IRA for that year, pay the 12% at the beginning, and avoid the 22% in retirement. More generally, Roth IRAs have a few advantages over traditional IRAs. First, Roth IRAs serve as a hedge against increasing tax rates, since, with any luck, it's more likely that the government will increase tax rates than it is that they will retroactively change Roth IRA contribution rules. You can also save up more with Roth IRAs. The contribution limit is the same for both kinds, but traditional IRAs have a tax assessed at the end, whereas Roth IRAs don't. Regardless, over the course of your life, there may be years where it will be better to contribute to a traditional IRA, and others where a Roth IRA will be preferable. Thankfully, you can open up both a traditional and Roth IRA and contribute to one or the other, depending on the year. Actually, you can open up as many IRAs as you like. Having multiple traditional IRA accounts can make sense for ease of accounting, for example. Just keep in mind that the $6,000 limit applies to all accounts as a group, not individually. Now, there are two other popular kinds of accounts that are called IRAs and that you might have heard of: simple IRAs and SEP IRAs. However, these aren't really different categories. Technically, they're special versions of the traditional IRA, since Roth rules don't apply to them. Strangely, though, they're also qualified plans, which means they're set up by employers. Honestly, it's not entirely clear why they're called IRAs in the first place. The best explanation is that they're often used by self-employed workers without employees, since the contribution limits are much higher than for normal IRAs. Either way, as with qualified plans, these accounts are different enough that they're best left for another video. IRAs are a powerful investment tool and are open to everyone. While the penalties for withdrawal mean that you should wait to make contributions until you're financially stable, the yearly limits mean that you should take advantage of them as soon as you can. Depending on your lifestyle, IRA contributions alone might not be enough to cover all your expenses in retirement, but they'll go a long way. This topic is complicated, so we weren't able to address every single point in this video. If you have any questions, though, feel free to leave them in the comments, and thanks for watching.